The 2008 financial crisis was explosive, sudden, loud, and unforgettable. It was a moment that shook the world's confidence in the financial system, sending shockwaves through every corner of the global economy. Bear Stearns vanished overnight, Lehman Brothers collapsed, and the world watched in panic as markets crashed. The chaos was visible, the fear was palpable, and the consequences were immediate. The villains and victims were clear, the headlines screamed, and the cause, housing, was obvious. The story was told in bold letters and desperate faces, with everyone searching for someone to blame. But 2026 is different. There's no single dramatic event, no thunderclap. The world moves on, seemingly undisturbed, as if nothing is wrong. Instead, we're living through a slow, silent unraveling, a crisis of 1,000 small cuts. Each day brings a new, almost invisible sign of strain, but nothing that screams disaster. Each cut is minor, easy to ignore, but together they're bleeding the system dry. The damage accumulates quietly, hidden in plain sight, as people go about their routines. The financial system isn't collapsing from one big problem, but from many small, interconnected ones. Like dominoes, each issue nudges the next, creating a chain reaction that's hard to see until it's too late. This time, there's no sense of urgency. The stock market looks strong, unemployment is low, and surface-level indicators numb us to deeper decay. The illusion of stability is powerful, masking the cracks beneath. The real danger? The system may already be broken before anyone notices. The warning signs are subtle. And, by the time they're recognized, the damage is already done. Commercial real estate cracks, rising consumer debt, corporate leverage. They see the warning lights flashing, even as the world looks away. They're quietly preparing, while the public sees calm. Behind closed doors, strategies are shifting, and contingency plans are drawn up. Headlines aren't screaming, pundits aren't panicking, so most assume all is well. The media's silence is almost reassuring, lulling everyone into complacency. This gap in perception is the defining feature of the silent crash of 2026. The disconnect between what's seen and what's real grows wider every day. It's not the crash you see coming. It's the one you never hear until it's too late. By the time the silence breaks, the consequences will be impossible to ignore. The silence is what makes it so dangerous. It hides the truth, allowing problems to grow unchecked, and leaves us unprepared for what's coming. The real story of 2026 is unfolding quietly, just beneath our feet. It's a crisis that whispers, not shouts, and that's why it's so easy to miss until it's already changed everything. A silent crash is like a slow leak inside a wall, unseen, but steadily destroying the structure. You don't hear the damage as it happens, but over time, the foundation weakens, and by the time you notice, it's often too late to prevent the worst of the consequences. No single sector is to blame. The damage is spread across commercial real estate, consumer credit, corporate debt, and regional banks. Each of these areas faces its own unique pressures, but together, they form a web of vulnerability that stretches across the entire economy. All are linked by one thing: mountains of debt taken on at low rates, now coming due at much higher costs. As interest rates rise, the burden grows heavier, and what once seemed manageable becomes a looming threat. No single failure grabs headlines, but the cumulative effect is enormous. The news rarely covers these slow-moving disasters, but their impact is felt everywhere. Instead of a dramatic collapse, we see thousands of small defaults, businesses, landlords, families, each one a drop in the bucket. These individual struggles rarely make the front page, but together, they signal a much larger problem brewing beneath the surface. Millions of these small failures drain liquidity, tighten credit, and slowly grind the economy to a halt. The ripple effects touch every corner of society, from local shops to major employers. The crash feels like a gradual slowdown, not a sudden disaster. Life continues, but with a sense of unease, as if something vital is slipping away. There's no clear trigger, no Minsky moment, just a constant, quiet erosion. Days turn into weeks, and weeks into months, as the underlying problems quietly intensify. Lenders extend loans to avoid losses, companies buy back stock with debt, consumers juggle credit cards. Everyone is trying to buy time, hoping for a turnaround that never quite arrives. These actions mask insolvency, pushing the reckoning further out. The problems are hidden, but they don't go away. They just grow in the shadows. But the problem only grows. Each delay adds to the eventual cost, making the final reckoning even more severe. The crash is silent because everyone is incentivized to pretend it isn't happening. From boardrooms to kitchen tables, denial becomes a coping mechanism. By the time the damage is visible, it's already done. The silent crash leaves scars that take years to heal, long after the headlines have moved on. The most overlooked part of this economic crisis is commercial real estate, a sector that quietly underpins much of our urban landscape, yet rarely makes headlines until it's too late. By the end of 2026, up to $188 trillion in commercial real estate loans must be refinanced. Triple last year's amount, and a staggering sum that threatens to overwhelm the system. Most of these loans were made during an era of ultra-low interest rates, when borrowing at 3 to 4% seemed like a safe bet for investors and property owners alike. Now, with rates soaring to 7 to 10%, refinancing has become a daunting, often impossible task for many. For many property owners, the math simply doesn't work anymore. Their buildings can't generate enough income to cover the new, much higher debt payments. Owners are left with three painful choices: default on their loans, sell at a steep loss, or, most commonly, extend and pretend, hoping for a miracle. Banks, too, are complicit, pushing out maturity dates, hoping for better times, but the underlying assets are zombies, generating just enough cash to survive but not to thrive. The office sector is the epicenter of this slow-moving disaster. Remote work has left entire buildings empty, property values plummeting, and refinancing nearly impossible for many owners. Delinquency rates in cities like Manhattan have soared to levels not seen in years, and distress indicators are flashing red, reaching multi-year highs as more loans go unpaid. The cracks are spreading beneath the surface, but for now, extensions and accounting tricks keep the street above looking deceptively smooth. The real damage is hidden from view, growing larger and more dangerous with each passing month. The illusion of stability is just that, an illusion, masking a crisis that could reshape our cities for years to come. While commercial real estate crumbles, household finances are quietly unraveling. U.S. credit card balances hit a record $1.23 trillion, a 60% jump since 2021. People are using credit for everyday expenses, not luxuries, with average credit card rates above 22%. Debt doubles in just over 3 years. Millions are trapped, barely covering interest, unable to pay down principal. Delinquencies are rising, especially among subprime borrowers, but creeping into higher tiers too. Student loan repayments have resumed, pushing millions closer to default. The stigma around debt keeps many silent, masking widespread distress. The consumer, the engine of U.S. growth, is running on fumes, propped up by unsustainable debt. The cracks are everywhere, but most are hidden from view. Banks aren't sounding alarms, but their actions speak volumes. They're quietly building loan loss reserves, stockpiling cash for expected defaults. In 2025, giants like J.P. Morgan and Bank of America set aside hundreds of millions for future losses. This is a clear signal. Banks expect more customers to default, especially in real estate and consumer credit. All major banks passed the Fed's stress tests, but their own actions suggest deeper worries. Regional banks are most exposed. They lack the global safety nets of big players. As more loans sour, these smaller banks will face a slow erosion of capital. The next wave won't be sudden failures, but a grinding, silent pressure on balance sheets. The public sees calm. Banks see the storm coming. Their quiet preparations are a warning in themselves. Corporate America is quietly piling on risk. Companies, especially in tech, are taking on record debt to fund projects and buy back stock. Margin debt has hit $1.21 trillion, nearly 4% of U.S. GDP. High margin debt accelerates downturns, falling stocks trigger forced selling, deepening crashes. Stock buybacks are at all-time highs, often funded by new debt, not profits. This boosts share prices but leaves companies more leveraged and vulnerable. The AI boom is adding fuel. Billions are being borrowed to chase speculative future returns. If AI profits disappoint, the bubble could burst. Corporate balance sheets look strong, but the foundation is fragile. The risk is hidden, but it's growing fast. Why don't more people see the danger? It's all about perception. Most judge the economy by the stock market, unemployment, and upbeat news. In 2026, these indicators look great, masking the real risks. The S&P 500 is near record highs, but valuations are disconnected from reality. Official reassurances like Fed stress tests lull the public into complacency. Insiders see the storm and prepare. The public is told all is well. The silent crash lacks a clear villain or simple story, so it's ignored. The warning signs are too quiet, too technical to grab attention. By the time the crisis is obvious, it's too late to prepare. The real alarm bells are ringing where few are listening. You're not powerless. Recognizing a silent crisis is the first step. Focus on your own fundamentals, reduce debt, build cash reserves, and question the hype. Aggressively pay down high-interest debt, credit cards, personal loans, before it traps you. Build a robust cash savings fund. Aim for at least 6 months of expenses. Cash gives you options when credit tightens or jobs disappear. Be skeptical of market highs and rosy headlines. Review your investments. Avoid overexposure to risky assets. Diversify, focus on quality, and align with your long-term goals. Quiet, deliberate action now is your best defense. Don't wait for the headlines. Prepare while it's still quiet. The real threat of the silent crash is complacency, not just financial loss. This crisis whispers, making it easy to ignore until it's too late. The cracks in real estate, household debt, and corporate leverage are all connected. The right response isn't panic, but quiet, steady preparation. Pay down debt, build savings, and stay skeptical. These are your best defenses. Insiders are preparing quietly. You should too. Become your own risk manager. Look past the headlines. The story of 2026 will be about a crisis ignored because it was too quiet. Take action now, without fanfare, and you'll be ready when the whispers become a roar. In a silent crisis, quiet action is your greatest strength.